Hello and welcome to BQ Prime. We're at the end of yet another RBI MPC decision. The MPC, as expected, decided to keep the benchmark repo rate and stance unchanged. It also continued to remain hawkish on inflation with its commentary, along with maintaining a close eye on evolving liquidity conditions. To discuss more on today's takeaways from the MPC, we're joined by Tanvee Gupta, Jain, UBS India economist, and Dhawal Dalal, CIO Fixed Income at Edelweiss MF. Thank you so much to both of you for taking time for us today.
Thank you.
So, Dhawal, I'd like to start with you. What were your takeaways from today's policy, especially some of the commentary on liquidity conditions and the benchmark reactions, the knee-jerk reactions we saw on the bond yields?
Yeah, so I think in more sense, the today's policy was pretty much same as what it was previously. The only change which was made was with regards to the RBI's announcement of use of OMO sale to manage liquidity. And I think that was the only additional statement that has set the cat among pigeons in the bond market and which has caused the bond yields to harden. Although I believe that it's a little bit of an overreaction because the RBI has very clearly said that this OMO sale tool is only a liquidity management tool and not an interest rate management tool. So to that extent, we do believe that the negative impact of the price action will subside at some point of time and the market will normalize soon.
And to add to that, I'd also want to ask, what's the liquidity trajectory looking like going forward? After today's commentary, can we expect liquidity to remain tight in the coming months?
So the liquidity, as the RBI governor alluded to, is likely to remain in a partly surplus once the government spending is going to come back into the market. And also from that perspective, between now and the November, we are going to see liquidity a little tighter, maybe plus minus 50,000 crore on average. But the bulk of the move is going to happen November onwards when the large redemptions or the maturity of the government bonds are going to change the liquidity scenario. So at that point of time, we'll have to see how the liquidity situation evolves. But at this point of time, between now and November, we do not expect the liquidity buildup to cause any kind of consternation within the RBI.
Okay, so the OMO operations that the governor alluded to, we would see OMOs happening only post the festive season, like maybe around after Diwali, if at all?
Absolutely. Nothing before that in our view, based on our analysis of the banking system liquidity between now and November.
All right. Tanvee, what were your takeaways on some of the commentary on liquidity as well as inflation in today's speech?
Sure, Pallavi. I think the biggest takeaway was the RBI governors reiterated that our inflation target is 4% and not 2 to 6%. And very clearly, the governor kind of highlighted that the entire idea is to align inflation towards a target on a durable basis and at the same time supporting growth. Because if I look at the policy, I mean, the stance was kept unchanged, the policy rate was kept unchanged. They didn't even tinker the inflation forecast. I mean, here and there, 20 basis point down in the September high on the September quarter, 10 basis point down in the December quarter. But largely, I would say the policy was on expected lines. So yes, one was very clearly RBI is highlighting that 4% is the medium-term target and where they would like inflation to be. In fact, very interestingly, they also released October monetary policy report. And if I look at the trajectory, what they're highlighting, how do they see inflation, say in FY25, the average inflation as per their current forecast, these are staff estimate, not really the MPC forecast. It is still at 4.5%. So definitely inflation is what they are clearly highlighting is going to be within that 4% or around the 4% medium-term target. The second interesting thing, as you guys, just discussed about is liquidity. Obviously, the market was taken by surprise when the RBI governor signaled that they could consider open market sales to manage liquidity if required. So we are expecting this liquidity tightening operations to sustain. I mean, very clearly, this incremental cash reserve ratio, which is getting discontinued, and there will be some festive season time which is coming in from mid-October to mid-November. and the government spending will also continue. So you are going to see that liquidity conditions remain towards neutral. But I would say if there is a concern that liquidity increase could actually lead to short-term rates closing below the repo rate, I think the liquidity tightening in terms of OMO sales will ensure that at least your overnight call money rate is trading closer to 6.5 to 6.75. I mean, they have been trading at 6.75 or 6.8, but entire idea will be that overnight rates trade slightly higher or closer to the repo rate.
Sure. So, some of the aspects of inflation that you've discussed, did you think it was a little bit contradictory, even going by early forecasts from the RBI for FY25 that you mentioned, for instance, versus fairly hawkish commentary on inflation, along with the governor reaffirming the fact that there are a lot of moving pieces at the moment when it comes to the inflation trajectory. So, overall, what's the picture? Is it a little bit of a mixed, confusing picture that comes across in terms of inflation trajectory?
Sure. So if you look at my inflation forecast at UBS, we are estimating inflation, CPI headline inflation to average 5.6%. So clearly 20 basis points higher than what RBI has been forecasting. Now, if I look at what are the three things I will be watching out in terms of inflation trajectory over the coming months, one, very clearly, I mean, vegetable prices are going to correct. We are already seeing the retail price data for the month of September for tomato especially is down almost 50% month on month. So you will see contraction on a sequential momentum. But I think there are clearly upside risks which are coming. For example, we did see that there were uneven rains. And even though your sowing for summer crop is largely flat year on year, but there is going to be an impact on the crop yields, especially in case of paddy or rice and pulses. And if I look at the actual retail prices, I can already see that there is a sequential increase in price momentum, whether it's rice, pulses, spices. So that is already feeding into my headline CPI inflation. Second is, I mean, oil prices continue to remain high. I mean, monetary policy report of RBI is taking oil at $85 for India. I mean, we have seen that the domestic retail fuel prices in India have been unchanged since May of 2022. I mean, we have not really seen the adverse impact of rise in crude oil prices, even when the number, the Brent was trading above $90 a barrel. Plus, India has been buying oil from Russia at a reasonable discount. But we are already seeing that there is an indirect impact because the input cost pressures faced by the firms, they are seeing that there is some feeding, which we are already seeing. So maybe not direct impact, but there is an indirect impact which is already feeding into the numbers. And third, and I think the most important thing, which we have to understand, that we are ahead of a very tight election calendar. We have 5 states going for elections in November, December. We have parliamentary elections due in April, May of next year. I mean, there will be, or at least we need to be watchful for any risk of populist spending, whether it is pro-rural, pro-social, and that can also lead to much more generalized inflationary pressures. So I think these are the 3 points or the factors which I will be watching out very closely to look at how inflation will actually pan out. But at the current juncture, we are 20 basis points higher than the RBI's forecast of 5.4%.
Got it. Okay, so Dhawal, we saw a fair bit of commentary from the governor today on liquidity management by banks as well. So going forward, do you think short-term rates will see a little bit of a softening now?
Unlikely, given the fact that right now, if you are seeing the 91-day T-bill cutoff, it's coming pretty much close to around 684, 685. We have seen a little bit of hardening on the 364-day T-bill cutoff last auction. From that perspective, I think we do believe that there's a little bit of term premium attached to the overnight rates, which are or closer to the 675 rate and over the 91-day term premium. So I do not expect short-term rates actually to trend lower. In fact, on the other hand, now that the RBI has basically shown their card about using OMO sales to modulate liquidity, my sense is that the supply in the money market will probably increase as some of the borrowers will probably try to preempt the potential hardening of bond money market yields and borrow money ahead of the festival season if required.
Got it. Dhawal, thank you so much for taking time out. This was most insightful.
Thank you very much.
So, Tanvee, coming back to you, the governor did re-emphasize that economic activity continues to stay fairly resilient despite a bunch of the risks that we've discussed so far. What's your take? What are high frequency indicators at this stage looking like? And one of the reasons I'm asking you this is because we do expect some deacceleration in growth in the second half of the year. So how does that juxtapose with festive spending coming up? What's the picture looking like?
Sure. So if I look at the high frequency data, and we actually have a lead indicator known as UBS India Composite Economic Indicator, which is basically a compilation of 15 high frequency data. So if I look at the trend in this indicator, it is showing me that on a seasonally adjusted sequential basis, this indicator was up 2.1% quarter on quarter in the September quarter. Till date, till whatever data points I have available so far for July, August, and September, versus it was up 4.5% in June. So clearly, I can see that the momentum has softened, but momentum is still positive. And this is a very good sign, which means the economic growth in India is still resilient at a time when we are seeing, there is a, lagged impact of monetary tightening, there is a weather-related uncertainty, and we know that there is a global headwinds, which are, global growth continues to slow. Notwithstanding the US economy, which so far has been quite resilient. One very interesting insight, which I was looking at the data, is that the K-shaped consumption pattern in India, which we have been highlighting, that seems to be continuing. I mean, when I looked at the high frequency data, it is suggesting that while the rural economy has recovered from the lows of the pandemic period, the urban economy continues to outperform the latter. In fact, most of the high frequency data on the rural economy are turning or showing a signs of slowdown. Maybe because of weather-related uncertainty, which we saw, August being one of the driest month. Then again, the rainfall trend improved in September. Second is the rural wage growth continues to be tapered, adjusted for inflation. Third is, all these government recent food supply measures, these could actually adversely affect the crop realization gain for the farmer. But if I look at the urban indicators, they're holding up very well despite depletion of accumulated pandemic-related savings. In fact, at UBS, we recently did an evidence lab survey of 1,500 affluent Indians. These are largely the upper class and the upper middle class. And this survey was recently conducted online in September of 2023. And it clearly showed that the urban Indian, affluent Indian consumption pattern are holding up. Almost 70% of the respondents expect that festive season spending will rise. 73% of the respondents expect stable to increasing income. If I looked at the purchase intentions, and these is again the affluent Indians or the upper middle class and upper class, I realized that the purchase intentions to buy a smartphone, to buy a two-wheeler, to buy a car, were pretty strong, largely resilient for property purchases. So definitely we are seeing that the urban affluent Indian consumption is holding up, and that is also one of the key reasons why your domestic economic activity in India is looking good so far.
Okay, so I do want to ask you one more question about some of the rural economy trends that you've highlighted. While trends when it comes to the urban economy seem to be far better defined, in terms of rural, we're still looking at a very mixed picture. NREGA, for instance, remains elevated compared to pre-pandemic demand for work under NREGA. And then, of course, we've seen, erratic monsoons, irrespective of whether output in terms of food production takes a hit or not. Rural incomes are more likely to take a little bit of a hit. Would that be the right way to look at it? Tanvee?
Yes. Okay. So in terms of rural economic indicators, yes, what you're saying is correct. The demand for work under NREGA has come down because sequentially and seasonally, this is like a busy period. You need people to help you on the farm. So people generally get employment. Plus, we were seeing a lot of front loading of government capex spending. If you look at the data till August, we have seen that both the center and the state government capex has been growing in double-digit levels. So there will be people getting job employment. So very rightly you're pointing out out that the data has been mixed. But yes, rural wage growth, I think, which is a very good indicator, because when I compare it with the urban wage proxy, which is the corporate revenue growth of the companies, I realize that urban wages in real terms are well into positive territory. But if I adjust the rural wages with inflation, which is running quite high, 6.5%, 7%, they're well into negative territory. So yes, in that sense, we are seeing quite a mixed trend. But I think what could support a rural economy, especially in the next 6 months, is in case we do see the government turning pro-rural, pro-socialist closer to election. For example, few things that I could expect in my base case could be picking up without really worsening my fiscal situation, could be expanding of outgo of National Rural Employment Guarantee Program, maybe extension of PM Kisan handout by 3,000 or 6,000 rupees as a one-time measure. It could be something more like a food secure, the free food ration scheme, which is the free food is kind of expiring in December 23. Maybe we get an extension by 3 to 6 months. So I think there is a possibility of more pro-rural. But if I look at many state governments, especially on the opposition side, we're already seeing that the populist spending in India has picked up. We are seeing cash handout to women, increase in minimum wages, cooking gas price cut. So we are already seeing some populism, measures which are picking up, which could bode well for the consumption in the near term.
Got it. We'll take a quick minute to welcome Jaideep Iyer, Head of Strategy at RBL Bank. So thank you so much for taking time out.
Thank you for having me. Thanks.
So, while most of today's decisions were fairly in line with expectations, I do want to ask you what you thought of announcements pertaining to liquidity management. The governor did have some comments, regarding better liquidity management from banks. What are your thoughts on that? And what do you think the situation will evolve to going forward?
Yeah, so I think clearly the tone was hawkish. They, want to have an eye on inflation. The statement of the fact that inflation target is not 2 to 6%, but 4% is very obvious. So I think, even if next year's inflation numbers in the first quarter is in the 5+ range, it is hard to justify, being complacent here. And that is clearly coming out in the messaging. So therefore, connected to that, the liquidity has been tight, and liquidity will be maintained from neutral to negative territory by RBI. When we saw the 2,000 rupee note coming into the system and liquidity therefore surging, naturally the temporary measure of ICRR was introduced, which sucked out liquidity, and now we are again back to a normalization situation, which will mean that we will be in the 0 to 50,000 crore deficit or 0 to 1 lakh crore deficit. And I think the RBI did make a statement. The good part was that they did not come out with any, messaging around CRR or any permanent way to suck out liquidity. I think an OMO-based liquidity sucking out is more, more tactical. And as and when they see liquidity being higher for whatever reasons, they will use OMOs to purchase. They also have to have an eye on currency. The dollar has strengthened across most currencies, and including a little bit with India, but we do have the benefit of large FX surpluses. So that would also mean that if you want to kind of have a stabilish rupee with a marginal depreciation kind of a situation, we need to keep liquidity tight. So I guess broadly speaking, the Reserve Bank will ensure that liquidity remains in neutral to negative territory.
Got it. I also do want to ask you about some of the comments on transmission. The governor did say that while transmission is underway, there's still some way to go for that. So, from the bank's perspective, can we expect some changes in lending rates going forward?
No, so I think there are two types broadly if I want to kind of divide the lending rates. One is largely linked to external benchmarks, and most banks have chosen repo rate as the external benchmark, and which therefore is an automatic transmission as and when the repo rate happens, and therefore today the loans are benchmarked at the 6.5% repo rate that we have. I think there is some room to go in terms of the transmission on the deposit side. So I think most banks would have raised their deposit rates from the lows during COVID to now in that 2% to 2.25% range. And maybe there is some scope. And I'm talking about the larger banks here clearly. Many of the mid-sized banks would have done already the 2.5% required because the deposit needs for smaller banks are typically high because of the growth that we have. But yes, I think there is some room on the deposit side where there is some increases which can come through.
Okay, so how much do you think is the headroom for transmission to improve by?
I think 25-30 basis points left at max, not much.
All right, okay.
On the deposit side, and I think on the lending side, we are largely done. I think the only reason why actually banks are in a bit of a odd situation where the lending is largely linked to repo. And the pricing is also dependent on liquidity and demand supply on deposits, and the ability to transmit that will be only dependent on basis when the repo rate changes. So on the lending side, it's largely at least on the retail side, which is where the RBI will be keenly watching, is substantially linked to repo or external benchmarks which have moved and therefore have been transmitted.
Right. So, weighted average lending rate is currently trending at about 9.5%. So going by your comments, would it be fair to say that it's expected to remain somewhat close to that figure?
Yeah, see, I think the challenge with the that number to look at from a transmission perspective is also the noise around mix, right? So if there is more lending on, let's say, arguably personal loans and less on home loans, then that weighted average lending rate will go up. Whereas if there is demand largely happening through home loans, then that weighted average lending rate may not move up. So there is an element of mix here which one will have to be careful about when we look at that rate. But broadly, I don't see that substantially moving up from here.
Got it. Okay. Tanvee, coming back to you for one quick closing question. After taking into account today's commentary and today's decisions, can we continue to expect higher for longer? What's it looking like?
Absolutely. I think this is our base case, and we have been highlighting that in India, the rates are likely to be kept on a prolonged pause, especially in a scenario, in the run-up to the 2024 elections, when there could be risk of a generalized inflationary pressures in India to pick up. I know the core inflation numbers continue to remain comfortable, but we need to take into account that the risk to inflation are definitely on an upside, whether it is because of global commodity prices, whether it is because of any risk of populist spending, or whether because of uneven weather, uncertainty, leading to further impact not only on the summer crop yield but also on the winter crop outlook. So clearly, our baseline is that we are expecting rates to be kept on a prolonged pause, no rate cut at all, at least till the June quarter of next year, and going forward, depending upon how the global economy also pans out. And but we will definitely keep a very close tab on liquidity, because I think the focus will be on using liquidity to ensure that the short-term rates are trading slightly higher than the repo rate in a scenario of generalized inflationary expectation, which could be picking up over the coming months.
Mr. Iyer, is that broadly in line with your expectations as well?
Yeah, totally. I think absolutely. I guess when RBI is very clear about not having an accommodative policy, they will keep liquidity negative. And we've seen short-term money market rates being a delta higher than repo rate. So yes, absolutely. And I think, just to add, if RBI itself is saying that, next year's June inflation is in the 5 handle and the target is 4 and not 2 to 6, I think it is, it is really difficult to imagine any cuts, maybe even a couple of quarters after that. So it's going to be a long pause, yes.
That's true. All right. Thank you so much to both of you for taking time out for us today.
Thank you very much. Thanks for having me.
Thank you.
As we're at the end of yet another policy, higher rates for longer, that continues to be the narrative. However, the central bank continues to maintain a very close eye on evolving inflation factors. Continue to stay tuned to BQ Prime for our continuing coverage of the Indian economy.